Live. Hi everyone. Can you hear me well? Just give me a thumbs up if you can hear me well, please. Hey Chip, welcome. Can you guys hear me? See. Okay, good to go. Awesome. Welcome Thomas, welcome Martin, welcome Andres. Hola, hola. Chris. Hi, Aaron. Hello, good to see you guys again. Luis, hello, hello. Welcome folks to the second training session of the securities trading training. Just so you know, so you won't find it awkward. Whenever I'm looking here, I'm actually looking at my second laptop. Hi Nordic. And hi Craig, sorry. And whenever I'm looking here, then I'm looking at my water, probably gonna take a sip. I got all the notes here that I'm going to take you through today. So it's going to be exciting. It's going to be fun, and I'll be taking, I got a couple of tips from the first session. Actually, a lady, I forget her name. Her name is Anne or Annette, but she gave me a good couple of tips. So instead of actually doing like the first session, asking a question, and then waiting for you to respond and having this awkward silence, I'll just continue on. I'll ask a question, and then I'll review all your responses at the end of the session. I'm also going to take all the general questions at the end of the session, and I'll respond to each one of them separately. So hopefully that works for you, but I think this way we have a momentum and we have a continuous session. So hi Max, welcome to the session. Today we will be discussing obviously the technical analysis basis. Actually, before I start, please hit the like and subscribe button. I see a lot of you here. YouTube actually take this a lot in consideration, so I would really appreciate it if you actually hit the like and the subscribe accordingly. Thank you very much. Okay, so let me get started. Just a recap of what we discussed in the first session. So in the first session, we focused more on trading psychology, okay? I'm not gonna go through all the detail. I'm just gonna take a couple of highlights, which I want you to be reminded of. And if you missed that session, the session is actually recorded. YouTube keeps a copy of that session for you to access. So please go through it, because hopefully there's a lot of information in there and a lot of tips and hints from a trading psychology perspective that you could benefit from. So to recap very quickly, we discussed the importance of emotions control. So the way you need to control your emotions, you need to think. Remember, I said think, trade with your mind rather than your heart. Do not react quickly to the market unless you actually know what you're stepping into. Have a plan. I discussed having a plan and knowing when to enter, when to exit. And I mentioned that the more we have of these sessions, you'll learn a lot of, the charting, you'll learn the skills that you need to know in order to know when you want to enter and when you want to exit. We discussed avoiding greed. So do not hold on to something for far too long because you're hoping that it's going to continue to increase more and more. Remember the saying, pigs get slaughtered. So if you show so much greed, you're probably going to return back to the original price, and it might even drop below your original price. So please do not get greedy. We also discussed about controlling your fear when bad news is actually shared. So remember, actually a perfect example happened over the past week. SNDL was a beautiful example of a ticker that announced their earnings. The earnings weren't that bad actually, but the reaction of the investors, the retail investors, was so much, there was so much panic that it actually dropped from 43 cents to 30 cents because of the panic selling. And guess what? The 30 cents, it was the support, which we will discuss in today's session. And you know what? A smart investor would have actually placed an order at support, 30 cents, and it bounced back literally in less than 5 minutes. to 38 or 39. I don't even recall. But there you go, 25%, just like that. Because of what? Because some people panic sold, whereas others played it smart and actually took the support level and they made 25% in less than 5 minutes. Yes, it did retrace, but you know what? You would have taken profits by then, because you know that the next day probably people are going to panic and they're going to sell even more and what have you. But that's the most important thing, knowing when to enter and when to exit. Okay. We also discuss know who you are following, whether it's on YouTube, whether on Twitter, and what have you. A lot of pumpers. In fact, I've seen a very funny thing that happened over this past week. Someone was actually pumping a stock, and that person was supposed to be exposing OTC scams. And unfortunately, that person was constantly tweeting about a single stock over and over and over again. I knew it was going to pump, but you know what? Do you want to really get into that? Some people don't mind the risk. Personally, I would not go into such a risk, because I understand that this person is actually pumping it. I don't care what his title is. I don't care whether he's an OTC expert or he exposes scams or what have you, because his actions or her actions, whoever was doing it, are against the SEC rules. Clearly, there was a pump. So just be careful of that and don't get burnt, because most of the time those pumps get you burnt at the end of the day. Okay. Many other points we discussed as well, so please feel free to review that session when you get a chance. I think there's a lot of value, and from the feedback, it was very positive. So hopefully, you'll get the chance to actually review it. And yes, Tyson, BRTXQ is the chart that I will use for some of my explanations. Okay, so before I get started, also, I want to highlight the charting software. So one of the best things that you guys could actually do for yourself, a favor that you can do for yourself, is actually to get the charting software. I personally use, as you can see, TradingView, okay? In order for you to actually apply whatever I'm doing and learn and chart while I'm doing these things, I strongly suggest that you get TradingView. Again, very quickly, I've included a link in the description of this YouTube video that basically provides you with a URL where you can go and get TradingView. Personally, I'm using Pro Plus. Pro Plus, I believe you pay $30 monthly. However, the moment you subscribe for 1 month, they immediately offer you to upgrade to a whole year, and they give you 6 months free of charge. So whatever you're paying actually for Pro Plus ends up being the same cost of Pro, okay? Of course, with more benefits and what have you. Also, with the link that I've included in the description, you will get $30 off. So basically, you're saving 7 months rather than 6 months. So to be honest, very worth it. Plus, you will get to actually try to do the same things that I'm doing right now during the training session and learn accordingly. Okay, that's pretty much it. Let's get into the training. So trading basics is the topic for today. And we'll be doing more and more tools and some tips on charting and training throughout the several weeks. But today we're going to discuss support and resistance levels. We're going to discuss Fibonacci levels, and we'll also discuss moving averages. I have a lot of notes, to be honest with you. So hopefully we'll get to moving averages, but if we don't, then we'll keep it to the next session, because I do not want to overload you with so much information and get you bored. You use Think or Swim. Excellent, Craig. Okay. That's fine. Whatever works for you is perfect. Personally, I also use TD Ameritrade and Think or Swim. I just personally prefer a separate software because it allows me with more analysis and what have you that I can't get with TD Ameritrade. But if that works for you, Think or Swim, then that's perfect. Okay, so something to keep in mind, the tools that I'm going to be sharing with you, ultimately you're going to use all of them or some of them. It depends on what you prefer. Not every trader is the same. Some people prefer to use certain tools, like for example, moving averages is a perfect example. I personally prefer using 5, 50, and 200 periods. Some other traders also like to use 8 and 21. All these numbers I'll be explaining shortly, but it really depends on your preference and how comfortable you get with the trading and what have you. Okay. So support and resistance, and I'm going to use BRTXQ for this segment. So Biorestorative Therapies Incorporated, for whoever doesn't know. So, but before jumping into the chart and showing you what's a support and what's a resistance, just a little bit of background. A support actually is an area where there is a surplus of buyers. Okay, so it acts as a support so that when the price actually decreases, it will hit that line and then bounce back. So it will support it not to decrease below that line or that price. A resistance, on the other case, is totally the opposite. So it is actually the line on top that the price actually hits and retraces back. Okay, if it doesn't manage to break it. On that resistance level, we have a surplus of sellers. Okay, so those are people who are actually wanting to sell their shares. And we have weak support and we have strong support. And then we have weak resistance and a strong resistance. Like the name stipulates, a weak support is one that actually you're probably going to break it and fall down even further. A weak resistance is one that you will actually be able to crack through and keep going to the next resistance level. A strong support is one that you probably have to hit way so many times in order to crack it, okay? And you need strong force in order for the price to go lower. And a strong resistance is actually a resistance where you will need extremely strong force and a lot of people buying. So there's a lot of buying power in order to be able to overcome it and increase in price even further. Okay, so you'll notice actually in my tweets, I always say, and even in my video reviews of stocks, I always say, if the price manages to make it over the support comfortably. So what I mean by comfortably is that if we say that the resistance, not support. If whenever I say the resistance, let's say the resistance is at $20, okay? So the price needs to be well above $20. So you'll say $21 for me to be comfortable that this actually has broken the resistance. Okay? If the price is actually at $20.02 or 3 cents or even 10 cents, I still do not feel comfortable that it has actually broken the resistance because the line could actually pull it back accordingly. Okay, so always think that you must break the resistance with strong force. Keep a far distance away from the resistance in order to say that you actually broke it, because the line will always try to pull it back. Okay, so this is an important point. Now, okay, so here is also a couple of things that we need to take in consideration. There's something called trade the bounce, and there's one that we call trade the break. So a lot of folks, in order to make sure that they have a good entry, they put their prices at their support level, okay? A strong support level, so that it would hit their price and then bounce back. So are you going to get the lowest price point? Probably not, but as long as you put your prices around the support level, you're most likely going to be profitable in the longer term. Also, the flip side, some people put their selling point close to the resistance levels. So when you put your selling point at a strong resistance level, the reason why you do that is because you know that there's a high chance that it might not break that resistance point, and then fall and ultimately would fall back. That's why you're taking the profit near the resistance, the strong resistance point, and this way you're not losing on the profits. Of course, all the strategy that I'm sharing right here is actually something that is applicable mostly to day traders and swing traders. So if you're holding something long term, you really don't care at the end of the day, because the price fluctuations that don't matter. If you believe that the price will ultimately increase over the next weeks, months, years, then you're just holding, and you're not gonna mind any of the other fluctuations. Okay, so the other one is trading the break. Which means basically an investor is actually buying in once the strong resistance is broken. So for instance, we'll go back to the earlier example. Percentage change to break the resistance. I'll take the questions at the end. So once the resistance actually breaks, let's say that the resistance is at $20, the same example that we used previously. If it was $20.10, a savvy investor would not actually get in yet, okay? They would probably get in at maybe 20.45 or 21. Yes, it's more expensive, but the chances are it's not going to pull back. Will it actually happen and it pulls back? Yeah, of course, it might happen, but trading is all about risk management, okay? So if it gets to 20.45 or 21, again, you're buying at a higher price point, but at least you know that it actually has a chance of going up even further and not returning back to a lower price point. So that's what I mean by trading the break from a resistance standpoint. Another point is for those who go short, for instance, they will not buy anything on the support level, the strong support level. They'll wait until the support is actually broken and then go short accordingly. So that's what we call trading the break. Okay, a very important point also that you need to take in consideration: the more you hit a support or the more you hit a resistance, actually the stronger it gets. Okay, so it's not the weaker it gets. I always joke around on Twitter and say the more you hit it, the weaker it gets. Actually, the truth is, the more you hit it, the stronger it gets. However, once you break through, okay, the support, for example, or the resistance, for example, once you break through the resistance, how long it actually took you to break that resistance is normally how strong the follow-through will be. So if you actually manage to break a weak resistance easily, the price is probably going to increase just a little bit. But if you actually went to a strong resistance and kept hitting it, bouncing and retracing, hitting it again, retracing, hitting it again, retracing, it has built such strength that the moment you break, probably the price is going to actually increase by force. So it will actually move higher than breaking a weaker resistance. So just keep that in mind accordingly. Hey, Brad. Okay, the follow through. Okay, so let's see on the chart, how does this actually all look. So I'm using, again, biorestorative therapies, BRTXQ chart, and here is an example of support right here. Okay, so also, actually, a very important point that I should state: a support is built when several candles are actually touching the same point. Okay, meaning that they all touch a certain price point at the same time. So notice here on BRTX, all these candles right here, they're all hovering around the same price. This is support. And if you notice right here, all these candles right here are hovering around the same point. This is support. This right here mentions several candles, okay? Well, not mentions, I mean highlights several candles. This is a weak support, for instance. Of course, you always need to expand the chart in order to see all throughout whether you have a strong support or a weak support, okay? So right here, for instance, you can tell that's a strong support. You can see it's right here, right here, right here. They're all touching the same point. Even right here, you notice it actually dropped, bounced back because there's a strong support. Okay? Resistance. Hopefully that's clear. And by the way, if I'm going too fast or if you guys are missing it at the end of the sessions and you have a question, I'll come back once again. But that's basically what it's all about. And you'll notice right here, actually, for those who have been trading BRTXQ, you'll notice actually the support right here held quite strongly. And it kept coming back, consolidating in this area. And then it started to move up on Friday. Okay? So the support held. If actually the support would have broken, it would have dropped quite nicely or poorly, depending how you're looking at it. Now, when we look at resistance, you'll notice right here, this is a strong resistance. And notice that's where we're stopping at this current point. So you know that BRTXQ, the moment it actually cracks through that resistance, it will shoot up because this is a really strong resistance right here. Look at that. Look at that. Let's expand the chart. Right here, right here, right here, right here, right here. All of it, it's a very strong resistance point right there. So the moment it cracks it, it will actually go up. Now, another point which I will be discussing later is the moving average right here. You'll notice that the 50-hour moving average is actually suppressing it. So, and that's another thing that I always discuss in my videos and I always share. The moving averages are a good indication of whether the price needs to overcome it in order to go up further, or it will not manage to overcome it accordingly. And that's why I always say it needs to open above the 50 hours moving average or 50-day moving average or the 5-hour moving average or the 5-day moving average. Okay, so just keep that in mind. So that's a strong resistance. We know that if it actually breaks that resistance, it will probably go up. And that's why in my review yesterday of BRTXQ, I said best case scenario is for it to open above the 50-hour moving average. Okay, perfect. So that's support and resistance. Again, you can see right here, this is a resistance point, but what do you guys think? This is actually, is it strong or weak? It has a couple of touch points, yes. So I would personally say it's a weak resistance point because of, there you go, bravo Max. So it's a weak resistance point because we don't have that much concentration as it's doing right here. It's only a couple of points. Yes, there are a couple of here, right? You're right, but probably it will not be a showstopper, okay? However, this line right here, the moving average, is probably going to give us a challenge once we break this. So keep that in mind, and that's why I say a combination of, always use a combination of tools, and that's why I say TradingView actually allows you to use multiple tools. Notice I have over this chart 6 different indicators: 5 moving average, 50 moving average, 200 moving average, stochastic RSI, MACD, and TTM squeeze. Remember also when I tweeted TTM squeeze, the red dots, and we'll discuss that in a separate session. I knew that it was going to shoot up because I saw a TTM squeeze. However, a caveat here, a TTM squeeze does not always mean that it's going to shoot up it could actually shoot down. And that's why you need to also use the indicators, other indicators, to know accordingly. So that's support and that's resistance. So the first topic is actually complete. And I'll take all the questions after we're done with that. Now, the next topic that we will be discussing, great, Andres. Trend lines is actually a good point. So let me, before we move away from supports and resistance, I want to tell you a trend line. What does a trend line mean? So a trend is normally how the price is actually moving. So there are 3 different trends that we know. We have an upward trend, there's a downward trend, and there's a sideways trend, or as we call it, consolidation. Okay? So right here, GRST, I'm looking at Ethema Health Corporation. You'll notice that there's a downward trend. Everything is moving down. And that's why you'll notice when I tweeted, and in my previous review videos, I said it needs to crack through the trend line in order to say that it has actually reversed. If it actually did not break that resistance line right here, you would expect it to keep going down, 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 down all the way. Okay? So always try to draw also a trend line right here to know the trend and know when it needs to actually break through it accordingly. Okay? That's a downward trend. What's an upward trend? There you go, right here. Right here. This is an upward trend. Okay. What is a sideways trend? There you go, right here. This is consolidation right here. This is consolidation right here. Okay. Yes, it has gone actually down, up, down, up. And you might be saying that, where is the consolidation? It actually stayed in a certain price range right there. There's not a drastic increase nor a drastic decrease. Okay. Yes, of course, when you're investing, you might see your account in red, but that's also where you need to control your emotions, because it did decrease, but it also stayed in the consolidation stage. So there's no reason to panic. Just control your emotions accordingly. Okay, so that's pretty much all I had for trend lines and what have you. It just allows you to better understand where the direction of the price is going. Up, down, sideways. Okay. All right. Hopefully we're doing well. Now we're going to move on to Fibonacci. I think we're going to actually only cover Fibonacci, and moving averages will be the next class, but we'll see how it goes. Okay, Fibonacci, I'm going to use SNDL for Fibonacci. Where's SNDL? Here you go. So Sundial Growers, and that's actually a Canadian company. So they actually do, or forget it. I don't even need to segue into that. But they work with marijuana and what have you. So medical marijuana. So what is Fibonacci? Fibonacci is actually called after Leonardo Fibonacci, who was an Italian mathematician. I won't go through the detail of the calculations of Fibonacci, because you can do that in your spare time if you want to read more about it. But it's but very briefly, it started off with 0, 1, then 1 plus 0 gives you 1, then 1 plus 1 gives you 2, 2 plus 1 gives you 3, 3 plus 2 gives you 5, and so forth. And then they divide those numbers in general. I don't want to confuse you, but if you are interested in the history and how the mathematical formula works, please read it on your own. The good news is the software actually provides you with the ability of drawing this and not worrying about those mathematical calculations accordingly. So Fibonacci is actually another way that traders use, a lot of traders actually use for profit taking, and also to know when they want to enter and exit a position. So it can actually be used with support levels in order to better understand when do you want to take a profit and when do you want to actually exit from a position. So that's and I'll show you that in a short period of time. There are actually four main Fibonacci retracement levels, okay? And those levels are normally the 0.236, 0.3882, 0.618, 0.764. Now you might be asking me, yeah, but there is also a 0.5 level that I see normally whenever I draw Fibonacci. Yes, you're actually right. The 0.5 level already exists. It came after Fibonacci. They inserted it, and then they decided, might as well just keep it. So yes, there exists a Fibonacci level at 0.5, and yes, prices do bounce off 0.5 or break through 0.5, and I'll be showing that shortly. Now there's another thing called Fibonacci extension levels, and the Fibonacci extension level, which I will show you also shortly, allows you to understand or better appreciate how far will the price increase following a retracement. There are several different levels, which are the 0.382, 0.618, 1.0, 1.382, and 1.618. Okay. Now, so I'll start charting here using SNDL just as an FYI. Okay, so you would appreciate that. In TradingView, you need to come here, and then the golden ratio, exactly, Craig. You click on Fib retracement, that's Fibonacci, and then you draw. The way you draw this, when you're actually going from you're trying to draw something that has taken off and then retraced, you need to start from what we call a swing low, which is the lowest candle, okay, to a swing high, which is the highest candle, right here. Okay, so you start from low to high, low to high. Now, if you're doing it the other way around, you draw it from high to low, high to low. That's where you start. Okay. Now, look how interesting and how important actually Fibonacci is. Notice this. This is the lowest point, which is where we drew the first line. This is the highest point where we drew the line. And notice how much it retraced. It went down, 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 down all the way. Oh, it bounced off here, which is the 0.786. And notice how spot on this actually happened. Okay. Yes, it did retrace here a little bit. Okay, but it actually held it. It was a strong point. Now, the other important point that I want you to take into consideration is that notice here. This is actually a support level. So Fibonacci actually tries to create something that mimics the support levels right here. Look at this, support level, right here. Notice, support level, support level. Now, the question that you might have, why wouldn't we, you draw fibs to highest red? That's what I did, actually. That's what I did. Okay. Oh, great question, actually, Jerry. So the fib, it depends. You need to appreciate that you're only looking at each cycle separately. You're not looking at the complete cycle. So if you're looking from so the next Fibonacci that you want to draw, let's take Jerry's question. So we know that it bounced off 0.786 on the first one. Now, to Jerry's point, here is the next cycle that happened, an increase in price. Hold on, right there. So this is the lowest, this is the highest, and there you go. It actually, right there. Okay, so if you want to actually start from the beginning, okay, so this is the full cycle. Couldn't see that thing. Yeah. So this is the first cycle, and we know that it bounced off 0.786. If you want to see the complete cycle for the next level, you actually draw it again from bottom to top, And guess what? Look at this. It actually bounced again from 0.786. Now, the question that you might be thinking about, is it always going to bounce at 0.786? No, it won't. This is only, it happened. It just happened on this chart that it traced to 0.786. However, based on my personal experience, it's a very popular level that typically stocks on NASDAQ tend to bounce off. However, do not rule out 0.618. Do not rule out 0.5. Do not rule out 0.382. Again, you have to watch the price action and act accordingly. And once again, you need to take each one separately if you want to appreciate how much they will be retracing and how much they will be continuing to move forward accordingly. Okay? So that's Fibonacci. Once again, low to high, and then monitor the price action. People, a smart investor would actually have an order right here, waiting for it to get filled in order to bounce back. SNDL is probably going to bounce back from here. Okay? Does it retrace sometimes 100%? Yes, it does. There's always exceptions, and that's what I mean. Always play this smart. If you see it retracing and you don't want to lose a lot of profits, just exit. Okay? That's how you need to think about it accordingly. Okay, be careful. Okay, Fibonacci extension levels. Okay, so what is, again, Fibonacci extension level actually allows you to predict how high this is going to go beyond a certain point. So let's take this first cycle right here and draw the Fibonacci extension levels. On TradingView, this is called the trend-based Fib extension, okay? Now, how do you actually build or draw the Fibonacci extension levels? You actually start from the swing low, you click to the top point of the swing high, and then you, oops, I actually did it wrong here. Click twice. Okay, hold on. Let me just restart this one. Delete. Okay. So you start at swing low, and then swing high, and then the third line is right here to the lowest point that it retraced. Okay. So now you have a chart that you actually know when you actually can take profits. So you'll notice it actually went up, and then right here, that was another profit point. Some investors might take their profits and get out of a trade right here. Yes, there is another point beyond that, but as you noticed, it actually broke that and then returned back to decrease. So that would have been a beautiful place to take profits. Did you actually have a chance to make more profits? Yes, you did. But the question is it worth the risk of actually not taking profits at this point and then start losing all the profits that you made? And you probably, if you would have been greedy, you would have probably lost all your profits or lost even more money. So that's a Fib extension. Think about it as a point that allows you to know how high it will go post a retracement. Post a retracement. Okay, so this would have been a profit level. This would have been a profit level. This, and this. You would have banked heavily if you actually would have sold here. Okay, some people might have exited here. You know what? All of them are smart investors because at the end of the day, they won. They did not lose. Okay. So that is Fibonacci extension levels. Actually, we'll have time to do moving averages. Hopefully that was clear. And I'll leave the last 15 minutes for questions. So moving averages, and I chose. I did not even choose a chart, but basically, we'll go back to my favorite stock, Biorestorative Therapies Incorporated, BRTXQ. So Moving averages are basically a way to smoothen the chart. And what I mean by that is that, when you're actually trading on the chart, you'll notice price fluctuations. The moving average actually allows it to smoothen those fluctuations accordingly. It allows you to distinguish between the noise, which is right here, for example, noise, and the actual price action, okay? Or the actual trend, I should say. The trend, as I mentioned earlier, is whether it's moving up, whether it's moving down, or it's moving sideways. There are two actually types of moving averages. There's a simple moving average, and there's an exponential moving average, okay? I personally use the simple moving average, okay? A simple moving average is one that, as the name indicates, it's very simple. For example, a 5-hour moving average will take the closing price, remember that, of the last 5 hours, add them up, divide by 5. That's it. Nothing complicated. 50 hours moving average. It will take the last 50-hour closing price, add them up, divide by 50. Okay? Now, there's a drawback to the simple moving average, which is it is actually susceptible to price spikes. So a spike can actually mess it up. So here, for example, a down right there might actually mess up the way you're actually analyzing or looking at things. However, once you get comfortable, you will be immune to these spikes. And that's why I say some people like simple moving average, some people prefer an exponential moving average. So a spike might give you a false signal, okay, which you need to keep in consideration as well. Now, what is an exponential moving average? An exponential moving average actually focuses more on the recent prices or the recent closing prices in order to assess the chart accordingly. So it will look, for example, at the last 3 hours only, and then average accordingly, and then look at the following 3 hours, It's always looking at the closer data points versus just taking a set of data points and averaging that out based on the number of data points that you're actually doing. Now, the next point that I want to highlight is the 5-day moving average. As you could appreciate, because the data points are so small or very close, the 5-hour moving average, for example, it will be closer to the price action compared to a higher period. For example, if we took the 50-day moving average, it is at a period of 50 different hours. So it will most likely be further away from the chart, okay? So that's what you need to, and that's why you notice actually on the chart on BRTXQ, the 5-day moving average is literally stuck to the chart. Whereas you notice the 50-day moving average is further away from the chart. The 200-day moving average is even further, okay? So it doesn't follow the action as much. And that's why I keep a lot of focus on the 5-hour moving average or the 5-day moving average or what have you. So keep that in mind. And once again, just to summarize, the simple moving average just does a normal average of a certain number of data points divided by that number of these data points. You add them up and divide by the number of data points. The exponential actually puts more weight on the more recent data points accordingly. Okay, so actually I managed to actually do it in exactly 15 minutes left. So that's pretty much it. Hopefully that was valuable and you benefited from it. I'm going to actually look at the questions and try to answer them from the beginning to till now, but please do start entering your questions, and this way I could look at them and respond accordingly. Gobi, RTX baby, oh hell yeah, yes, definitely. Percent change to break the resistance. Chris, I do not understand your question, so if you can please clarify what you mean by percentage change to break the resistance, that would be great. Thank you. Jerry, why wouldn't, okay, we've responded to that. A significant crossing, how do I identify the resistance? Okay, so let me go back and explain that one. So a resistance is a set of data points or several candles that are actually touching a certain price point, Andres, at the same time, and the same for the support, okay? However, when the price is below this set of data points, then it's actually a resistance. When the price is higher, then it's actually just like here, this price point is higher than this price point. This is a support, and this is a resistance, okay? Once you break through the resistance becomes support. So once this price actually goes right here, this becomes the support, and the next resistance point becomes right here. Okay? Hopefully that answers your question. Okay. Any other questions, folks, on this, or are we good to go? I'll be thinking of what I need to provide on the next session. Maybe we'll have more on candles. We'll learn more about other stuff, but I'll be announcing it and actually including it in the title of the next video. However, for now, I think that's pretty much all I wanted to cover today. Again, hopefully you found value. Hopefully that was helpful. Please think about it when you're actually trading. Here's another question. Is there a specific percentage above support that you would expect an increase? That's a great question. So scientifically, we don't have anything to measure it, Chris. However, all I'm going to say once again, if it actually hit a resistance for several hours or several days and it kept on retracing, you know that it will follow through with force. That's all I can tell you. It will definitely go stronger and higher than breaking a weak resistance. And similarly for support, if you're actually if the price is actually hitting the support multiple times for hours or for days or for weeks or whatever it is, and it's failing, it keeps bouncing back up, rest assured that the moment it breaks it, it will fall. It will be a free fall. Let's just put it that way. Very good session. Thank you, Hunt. Appreciate it. Brad, is it true that a lot of moving averages in OTC is harder to figure out because there are more day traders using stop loss because of volatility? Okay, so that's a very valid question, a very good question. OTC is a different market, okay? And yes, a lot of people use stop losses because of the fact that they don't want to lose 10%, 20%, 30%, even 40%, you know? OTC is a market where you can actually lose quite quickly. I personally am a very patient investor. So if it drops by 20%, I know I'm trading in the OTC market. I really don't care. I manage my emotions. I do not panic. And that's where I hope that the level that you will get to, you will not be worried about that. However, if you're comfortable with 10% getting out, if you lose 10%, again, I'm not a financial advisor. I'm only providing you with hopefully helpful tips. But if you hate seeing yourself falling 20%, 30%, then yes, have a stop loss. My only concern in the OTC market is that it's so volatile that you'll probably be losing a lot of money all the time because you're putting a stop loss. So you need to appreciate the market that you're in. If you're in NASDAQ, then yes, 10% might be a lot, 15% might be a lot. We're actually in a period right now where everything is increasing and decreasing heavily and quite quickly. So you need to understand the timing, you need to understand the market dynamics, and you need to control your emotions. and know exactly what you personally want. If you don't want to see it, see your account go in the red heavily, then please get out. My thing is, you know what, if I do that all the time, I'm probably going to be losing a lot of money. Master your charting skills, master what you're capable of reading, and I think you will be absolutely fine, and you'll have the full confidence that even if something drops 10%, 15%, that it will bounce back because your charting tells you so. And that's why I always say technical analysis, the moment you master it, you'll be able to control your own destiny. Do not believe anyone who tells you that the OTC market, because of its volatility, you cannot read the chart. I'm not bragging or anything, but a lot of you know that I've actually called the charts per the exact price, even in the OTC market. The people who tell you that you cannot apply the chart in the OTC market, they don't know how to do technical analysis, or they haven't perfected their technical analysis just yet. So I think learn the skill mostly, and then you'll get better at it. Hopefully I answered your question, Brad. I made the mistake of trading too much when I first started. We all do the mistake, Craig. Hey, when I started off, I lost so much money. So don't beat yourself on it. As I mentioned in the last session, we all make mistakes. We all learn from the mistakes. As I said in my last session, you make the mistakes once, it's okay, we learn. You make the mistake twice, then yes, okay, whatever happened. The third time, I do not forgive myself. So I only allow myself to make the mistake twice. If I make it third time, I have no one to blame but myself. And that's the rule that you should always try to apply within trading, within your life in general. That's the rule that I go through. Yes, it might be hard on myself, but you know, I wasn't hard the first and the second time, but the third time I deserve a slap. Okay, so okay, any other questions before we close, or are we good to go? Hit that like and subscribe button if you haven't, please. And let's increase that. Okay, Suraj, I learned never to chase trade. Perfect, Suraj. Please do not chase any trading, even if it increases. Again, I said it last time. Even if something increases by 100% and then later on it increases by 200, 300, 400, not worth it. There are so many opportunities out there. Why chase and end up holding a bag? Awesome, Chip. I'm glad you did. Thanks, Max. I appreciate it. Thomas, thank you. Okay, folks, I think we're good to go. Thank you so much for your time, and hopefully that was valuable. I once again keep liking and keep subscribing. Spread the word. Let's grow as a community, and let's learn together. Good luck on Monday. I'll be posting more charts tomorrow, and I wish you all the best. Have a great evening, guys. Take care. Bye-bye.